Thank you all. Thank you, panelists, for a great discussion again. Welcome to the 8th Annual Hispanic Heritage Foundation Investor Forum. And for those who just joined us, questions on the chat box and also comments, make sure that they're visible to all. We want to also take the opportunity to thank our sponsor, TIAA Institute, for their continued support. And up next, we have Opportunities in Real Estate and Real Assets panel. Joining the panel, we have real estate and real asset investors who will discuss the current state of investment opportunities and how the lending environment has impacted their assets. Moderating the panel, we have Corinne Tapia Babcock, Commissioner at Los Angeles Fire and Police Pensions. Corinne, are you ready? This is all you. Welcome, everyone.
Good afternoon, everyone. Thank you so much and appreciate everybody's patience this morning and afternoon. I know myself, I just came out of my LAFPP board meeting, so I haven't been able to fully participate yet, but what I've seen has been quite impressive. So I'm going to get right into this just because there's so much great knowledge on this panel and we only have a limited amount of time. So I want to make sure we get to everyone. So what I'm going to do is I'm going to introduce each person, but as I introduce them, I'm going to also let them say a couple things on their experience and their focus on this particular topic, real estate and real assets. First, we have Sasha Bernier. He is the Senior Vice President and Investment Committee member of Chentelham Investments. Sasha is, they focus single family office on investing in both debt and equity, primarily in real estate opportunities and lower middle market companies. So Sasha, can you give us a little bit of color on that and put it in some terms that others may understand, and especially seeing where we're at in this past year during the pandemic, how that shakes out?
Yeah, thank you for having me, Hispanic Heritage Foundation. So, you know, I've been investing for the family for close to 10 years and really started around 08, 09. And during that period of time is when we really saw amazing opportunities. And at that time, most of that was formed because the banks were in trouble. And so there was a lack of liquidity at the time. And because you couldn't get financing or banks had to sell assets to clean up their balance sheets, it was really a great exposure in the beginning to see what a distressed environment really meant. And just to think about the cycle, and as that went through, there were opportunities in primarily in multifamily, where we really started was really one of the best segments because people always need a place to live. It never changes, really depends still on communities and things of that nature. And the past year, though, 2020, so as the market got more liquid and the market started pumping more money into the market, we thought that we would eventually see a correction. And when you think about the spectrum and the evolution, real estate almost became like the stock market because everyone understood it. Money just started flooding. And for the past 9 years, we've been telling ourselves we're in the 9th inning, and we've been wrong for the past 9 years. And when COVID came, we really thought that that 2000 we would see something similar to 2008 and 2009, but it was actually the opposite of what we saw, especially again in multifamily, because multifamily seems to be really where people think as the safe haven of all the asset classes. Obviously, when you think about distress, there's retail, but it's still been hard to really figure out where retail is going to shape up because the internet has continued to gain market share. When you think about industrial, probably the most attractive segment, but industrial is difficult also now because all the capital is going in there, right? And so it's really best to be opportunistic and patient because multifamily, industrial, are asset classes that people see as really the safe zones. And so money really just keeps pouring. And we've adjusted by going up the capital structure where we started off as equity, then we went to preferred equity, tried debt, but it's all seemed to have converged. And what I mean by converging, there's just a rush to keep capital safe, and not only keep capital safe, get some type of return income. And so people are willing to get lesser returns. And think about this, right? Really think about this, Kearney. If you are doing a multifamily, you're doing a multifamily asset, right? And the debt, the bank debt, right, ranges from 3 to 5%, right? And yeah, you're seeing people say, okay, yeah, we'll take a cash for, like, I was talking to an independent sponsor today, and they're like, yeah, I was asking, hey, I haven't seen any deals from you. What's going on? He's like, yeah, well, we know that right now you still like 8%, but the market's really 5-6%. Think about that. That's insane, right? So you have debt that's getting almost the same return, right, as equity with that leverage. And when you really step down and think about it, it's crazy. You would never do that trade, right?
Right.
So right now, it's a difficult market, but I just encourage people like to tread. There's no need to rush. And if I had to pick a location, I'd say the Southeast, where it's growing, Florida, Texas. Obviously, everyone wants to be in those markets, and the Southwest are probably the most attractive market. So thank you.
Okay, yeah, let's hold there on geographic, because I don't want to get too on that, because I do want to have some folks focus on that, but I appreciate that for you keeping in mind the industrial side, multifamily, the Southeast, the Southwest. I think those are some buzzwords that we'll kind of go through this. I want to go over to Luis Sanchez, the Senior Vice President of Adelante Capital Management. Luis has over 33 years of experience in the commercial real estate lending market. So I really want Luis to to give us a little bit of a color, as we look to the public securities and that side of what this all means in real estate. If Luis, you can give us some color there, I'd appreciate it. I think you're on mute, Luis.
Sorry about that.
There you are, Luis.
Thanks, Corinne. So I actually did start out my career in real estate on the lending side, but I've been involved in the publicly listed securities market now for the last 16 years or so. Just a quick background about Adelante Capital is we're a boutique investment management firm that's focused on invested in real estate for our clients really through the public equity market. So we're invested in not directly in the ownership and management of real estate, but really in publicly listed companies that have the fully integrated operating platforms to own and operate real estate. So if I look at the history of the firm, and we've been involved, I think last year we hit a milestone, I think 25 years of investing in the public listed real estate securities market. So, and over that time frame, there's been quite an evolution. I think if you go back a couple of decades, when maybe the REIT market started in the mid 90s and into the 2000s, historically, it was probably more dominated by what would be considered maybe the traditional core property types, office, industrial, multifamily, and retail, shopping centers, malls. But I think over the past decade or so, there's been quite an evolution, I think, in the public listed market to really incorporate a wide array of different property types that I think can sometimes be difficult to access for investors in the private market. So today, just a rough order of magnitude, the public listed real estate securities market is equity market cap, call it about 1.2 trillion, plus or minus, with a gross asset value of $3 trillion plus. And if you look at the makeup of the listed market, it's evolved again to incorporate a lot more different property types beyond those four core property types that I mentioned. Today, in the public markets, you can invest in single family rentals, self-storage, laboratory office or life science space, which is a hot property type, data centers, cell tower companies. So quite a wide range of opportunity sets for investors to invest in the public market. So just to kind of bring it back to sort of the environment and looking at least from the public market lens that we have over the last, call it 12 to 15 months, as we kind of went through the period of the pandemic, a little over a year ago when it all started, to where we are today. I think when I think about the operating environment for real estate, you can kind of describe it probably over the last year with one word, and that's dispersion. And what I mean by dispersion is there really are property types that I would say were much more severely impacted by the disruption of the pandemic. And there were others that were less so and actually did fairly well during most of the pandemic. And so just by way of example, you think it's, what was most disrupted by the pandemic? You think retail. I think, as Sasha mentioned, retail, I think even before the pandemic, there was this sort of growth of e-commerce that was a bit of a threat to the bricks and mortars retail. So that accelerated during the pandemic. Office, we all, just like today, I'm working from home. A lot of us had to revert to sort of the home office, at least temporarily. And, what we thought was maybe a month or two has dragged on to be, now a year plus. And I think we're all obviously optimistic as we've made all this progress that over the course of the summer and into the fall, you'll see this return to the office. So although a lot of debate, I think, in the markets about what that return to the office is going to look like in terms of what the demand is going to look like. Another sector that got hit obviously and disrupted, like lodging is another example. Obviously, we couldn't travel, leisure travel, business travel, so all disrupted again, severely impacted in terms of the operating fundamentals. Then you go to the other side of the equation, and you see sectors that have done well actually over the course of the last 12 to 15 months. I think Sasha mentioned industrial logistics. Okay, so as e-commerce growth accelerated, historically pre-pandemic, e-commerce probably made up about 15% plus or minus of retail total sales. That grew. Obviously, we all had to revert to a lot more online shopping just for, obviously health and safety issues and convenience. That's been a benefit to owners of warehouse space. I think as e-commerce has grown, there's been greater demand for logistics space. Another sector that has prospered over the last year that you can access in the public markets is life science, which is lab space. And that's kind of a bit of a niche sector of office. And what a lab space is basically, it looks like an office building from the outside, but typically you might have about 60% of lab space that is used for research by biotech companies, big pharma, looking for therapeutics, vaccines, other medical research, and typically they're in cluster markets around the country. That sector has done very well. Another sector, single family rentals. If you think about a single family rental home and the ability to rent it as opposed to buy it, I think there's been an evolving demand in that sector over the past decade for folks who either like the flexibility. You think about millennials who, as they get a little bit older, want to have the flexibility of living in a single family home versus buying, or, maybe obviously with home prices haven't appreciated so much, that's made it more accessible. So again, you have this sort of dispersion in how properties have performed over the last year. And I think one of the unique aspects of the public markets is it gives you this access to this wide array of properties. And so that kind of brings us to where we are today. And I think obviously, we've all are very happy that we've made a lot of progress. I think a big turning point that we saw, at least in the public markets, it was really, I think, last November. I think from the beginning of the pandemic, over the course of the last year, again, some sectors did well, others didn't. But I think there was a much big a pivot point, I think, at least in the public markets in November when we had the original news with the vaccines, with the Pfizer announcement, the Moderna. Even though operating fundamentals didn't really change all that much, I think there was certainly the forward-looking anticipation in the public markets that things were going to get better. And so over the course of the last, call it 6+ months, I think we've seen some momentum, maybe ahead of where the improvement in the operating fundamentals have been. So as we look today, again, I think there's sectors that are doing well, others that are in that what I would call recovery mode as the economy continues to reopen, and hopefully improvement in operating fundamentals over time. So I'll leave it at that. Hopefully I gave just a brief overview.
You did. Thank you, Luis. I appreciate you mentioning the life sciences. I know I'm in Northeast Los Angeles, and we play off a USC Keck Medical Center, and I'm noticing that folks are taking over a pretty strong corridor there, coming in and revamping space that's making it into lab space, and really what they're calling a hatch office kind of situation of they're converting those into those biotech labs that you're speaking of. So I think we're going to see that in different places throughout the country as well, like you said, in different markets. Let me go over to Mina Pacheco-Nazemi. She's the co-head of funds and co-investments for Barings. Mina serves on both the investment committee and valuation committee. She's responsible for originating, underwriting, and monitoring primary fund, direct co-investments, and secondary fund opportunities for private equity and real assets. Mina, I think you bring to us quite a bit of experience. We know that. Most people here know who you are, in particular around real assets and this time period that we've been in, particularly focused on, let's say the last 12 months. We're in June now, where we came out of, everybody was, I think, fearful of this particular asset class after COVID, but here we are now. So shed some light for us from your experience.
Well, thank you. And because I'm following Luis, a lot of people may not know this, but my first job was out of Prudential. And so over 20 years ago, I worked for Luis out in the San Francisco office. So, so it's a small world. Well, thanks for having me. I know I talk a lot about what we do here on the private equity side, especially from an emerging managers standpoint, working with independent sponsors, but we're actually very, very active. Half of our book, what we manage here is on the real asset side. Maybe kind of thematically, what we kind of spend our time on is there's a lot of crossover on the real estate, which is just, where we are from an energy transition. So the movement from centralized power to decentralized assets, right? Now, before you used to kind of mine coal and then take it to a plant and burn it, and it would be distributed, that energy would be distributed. Now you put solar panels up on roofs. You're seeing that on very large complexes, whether they're industrial complexes, and leveraging just kind of the space they have on the top of the roof as an example. So we've been doing quite a bit around the concept of energy transition, and you think about all the opportunities that come from network from EV vehicles and the charging stations, battery, the use of battery power as well, to kind of manage kind of the peak loads, what we saw in Texas, a few months ago now. So we do invest quite a bit around that, around those themes. Related to that is around sustainability, which obviously renewables kind of hit on it, water conservation, and managing kind of waste. So waste management, capturing methane from landfills. We've done quite a bit around that strategy. And then third, I would say the theme around consumer, the working from home, obviously has become a bigger theme overall. We've invested quite a bit in fiber and in different, everything kind of related to the technology, and also not only the infrastructure around working from home and making sure you have internet. There's actually a very, very big push in just making sure that kind of along the lines of the last mile, but making sure that every American is able to get access to the internet, right? Since we saw that, especially as I think about our audience here, Latinos, that is really, really critical, is making sure that, as we saw, many of our children, across the country didn't have even access to the internet and couldn't go to school. So we do think a lot about that, and from a strategy perspective, from a, ESG perspective, and then everything related from a data and usage and the requirements around that. So that's kind of how the three themes that we're investing in. And frankly, a lot of it we're seeing is on the smaller end of the market. So again, consistent with kind of always my theme around smaller niche players and smaller managers. And frankly, the bigger managers, kind of the Macquaries of the world, the GIPs of the world, are doing really, really big transactions. So we do find a lot of opportunities for smaller managers, and they could be women and diverse managers as well, and taking advantage of the Biden infrastructure bill. So I'll just stop there.
Thank you, Mina. I appreciate you bringing up the small emerging manager. I know at LAFPP, we don't talk about it much on the real estate side. As you all probably know, we do it more on private equity, but not on the real estate front or focus. So that's a goal of mine to push that agenda forward at some point. I'm going to go over to Martin Cabrera. He's the CEO and founder of Cabrera Capital Markets and Cabrera Capital Partners. Cabrera Capital Partners provides commercial and residential real estate development expertise, investment, and consulting services to a full range of clients in the public, private, institutional, and nonprofit sectors. Marty, I know you have such a wide range of experience. I'm going to let you take it away, but I know you'd be remiss to not mention affordable housing at some point in your conversation. But let's hear from you.
No, thanks, Corinne. And it's a pleasure to be here. And I want to thank Manuel Pleites as well for putting this on. I'm glad it's in its 8th year and everyone kind of participating and seeing it grow. So as Corinne mentioned, we have a real estate development group, and we had pulled in a team back in 2012 who was running institutional assets, about $3.5 billion at the previous firm, but really kind of focusing on some of the areas that we felt were some growth areas. And, you know, the market has changed. I think to Sasha's point, folks have been saying, you know, we're in the 9th inning of real estate for probably the last 5 or 6 years. And we've had some tremendous growth, but we still think there are a lot of opportunities out there. We currently are developing about a $400 million project on the southwest side of Chicago. And we're the lead developer. We also have another residential developer as our minority partner, and also Chicago Housing Authority. So it's roughly about a 650 unit project, and with commercial, kind of with daycare center, community center, but also a large grocer to anchor the development, and a healthcare provider as well for the neighborhood. And you know, it's interesting because of those units, it's probably going to be about 70 to 75% affordable housing, which is a big issue in Chicago, but also in New York, Los Angeles, kind of throughout the country, San Francisco. And, you know, the folks have mentioned, it's like, well, you have an impact kind of development. And it's like, well, we're just looking at it for the returns. And, but we know that we can kind of go into some of these neighborhoods, and this particular development, the LeClaire redevelopment, is in predominantly Latino area, and there's a small pocket of African Americans and some white Caucasian as well. But we know that this will be the anchor investment. It's probably the largest investment in the Southwest Side's history, and it's right by Midway Airport. But it is impactful in the sense that there'll be 1,600 jobs created. But the affordable housing aspect is key to it as well. And it's also where you can have an impact. One of the things that, you know, we learned is, as Mina mentioned, that there are so many of our folks in the communities that don't have access to Wi-Fi. So, and the design of it, it's ensuring that kind of all folks in the development, it's about 36 acres, will have access to Wi-Fi. And with all of the rooftops, it's also kind of having solar panels on those rooftops as well to, one, it brings more fees and incentives from the federal government as well as from the state, but it's falls under the ESG category and kind of the green space, where it does allow us to get some other additional kind of incentives. And I think to Corinne's point, affordable housing is a major issue throughout the country, and you have to really look as there are more costs that are increasing. You know, it just makes your capital stack a lot more difficult with new market tax credits, TIFs, kind of any types of incentives. And, you know, from our investment banking background for the firm, that's what we've done, is put capital stacks together on debt as well as equity. And so it allows us to kind of go out there and take advantage of some of those opportunities with different cities and states where we can look at kind of affordable housing opportunities. And we're looking at about 4 projects in the LA County area. And, you know, I think the demand there in just California alone, it'll take 212 years to meet. So it'll never be in our lifetime, but it'll give you a sense of the issue and the problems of the need for affordable housing, which I think that's just going to continue to grow. But it has allowed us to also, as one of our capital providers, to go and source other Latino and African American developers throughout the country that we can co-develop some of these projects with. And it's looking at some of the local sharpshooters that we can team up with that can give us kind of those returns, but also kind of we're providing the capital. And similar to our project in Chicago, it's not just us as the Latino developer. It's also the architects, the engineers, the lawyers that are Black and brown, and that are great at what they do, and they just haven't given the opportunities to be lead in those characteristics. So the general contractors as well. So it's gotten the attention of some of the largest capital providers of what we're doing. And we know that we can do well and get the great returns, but also kind of be inclusive. So it is trickling down. With that, I'll go ahead and hand it back to you, Corinne.
I appreciate you mentioning that, Marty. I know one of the items that I push when anytime we're making a real estate investment is whether it's a purchase of a building or a brand new development, there's so many facets to real estate and how many people can be involved, whether it's the broker, the property manager, the title company, the contractor on site, the plumber, the elevator guy. I mean, there's just so many pieces to a property, to a piece of development, that if we're not plugging in Latinos and African Americans and Asian Pacific Islanders and all the folks out there that have a hard time getting into these things, and we're really not doing anything that we should be doing, because there's such huge opportunity to really take that to the next level, and we haven't got there yet. So thank you for bringing that up, because that's a huge piece of real estate and where we could take it. I'm going to go over to Andre Bueno, the Vice President of Bueno Group. He has over 15 years of real estate experience. Andre is responsible for the founding and overseeing of Bueno Group, a vertically integrated real estate development company. Since 2006, he's redeveloped and repositioned 400 plus apartments across 3 states. And I know because Andre is a colleague and friend, that he's looking for his next opportunity. So Andre, tell us where you are seeing things and where you're focused right now.
Absolutely, thank you. I guess to kind of follow the theme of how small of a world it was, after my first internship on Wall Street, I tried to work for Mina. So hey Mina, what's up? So it's been really interesting kind of seeing how the cycle has kind of played out. 2008 to 2011, we saw financing really decrease, especially in a lot of these like metropolitan cities. So it really created these supply and demand imbalances when it came to housing product. I focus specifically on the boots on the ground. We're a real estate development company. We've done 25 projects over the last 7 years. Different parts of the country were affected differently as the cycle kind of happened. We saw, when the pandemic kind of hit, we saw U-Hauls really leaving San Francisco and New York and California really at an unprecedented pace. And you were seeing all of them end up in places like the Sun Belt. So Texas, Atlanta, South Florida. And during that time, we also saw a lot of different supply chain shocks. So in terms of like the raw materials for how the industry's put together, so lumber, steel, copper, cement, everything started really ratcheting up. And it was really fascinating because on one hand, a lot of people started thinking about what's their footprint in terms of how they're making their investment decisions or how they're building or investing into these different products. Groups were formed, to Corinne's point. Real was one of them. Is a group specifically focused for Latinos to really provide advancement and opportunities within the commercial real estate space. And we actually started seeing this play out in the kinds of projects that were becoming available, the kinds of financing sources, what people and investors were more interested in. From an ESG perspective, we saw different products come out, such as PACE financing, which was coming out to essentially act as a sort of mezz financing piece to justify reinvestment back into traditional real estate assets for sustainability purposes. And a lot of that, we started seeing that also play out in different asset classes. So in the retail side, more assets are becoming more experiential. So regional malls really started, being challenged during that time period. Up north, recently, Prologis acquired a shopping center in the Richmond area, and they're converting it to a mixed-use industrial park. And this was an asset that was actually owned by ERS out of Texas, and it was fascinating to see this because in terms of like different opportunities, we were chasing a 43-acre redevelopment here in Los Angeles of a regional mall. And a lot of those different themes that were talked about earlier in the panel, in terms of like affordable housing and how we're thinking about sustainability, those really started to come into play. In which you now have a lot more cash that's on the sidelines. You have this pent-up demand of capital that's out chasing deals. So a lot of it becomes a lot more, I guess, intricate, how deal flow is really found, how returns are really generated at this stage of the cycle, and really what kind of financing options there are out there. And as such, it's quite interesting to see all the innovation that's really come out of the last year. I spent a lot of the last year boots on the ground working on leasing an apartment building in California, which was losing an incredible amount of people. Meanwhile, I sold my entire business in the Midwest because lots of capital is chasing the stability that the Midwest brings. We saw also a tremendous amount of public-private partnership opportunities with different cities and municipalities as everyone's looking to tackle how do you solve for these different inequities, but you do this in a programmatic fashion. Do you provide inclusionary zoning? Do you find different ways of affecting the supply chain by mandating, a project labor agreement, or how many people come from a specific community that are hired into these different programs? And when we started thinking about that next generation of who should we be partnering with, I think it's incumbent as we look back at our own communities and, to Mina's point, really talking about how broadband connectivity is really a challenge in these minority neighborhoods. When we have access to partner with big tech, they're also seeing this as an opportunity to fulfill a lot of their ESG mandates. And sometimes those have been, really great partners. Google, for one, was a tremendous real estate partners where we're looking at different projects here in Los Angeles.
Excellent. Thank you, Andre. Appreciate you bringing up some of those nuances of what's happening out there and some recent types of transactions to give us that color. And congratulations on selling your portfolio in the Midwest. Always a good thing when you get a return. Last but not least, to give us her expertise, Carly Tripp, Global Chief Investment Officer and Head of Nuveen Real Estate Investments. Carly, she oversees 200 plus investment professionals, and Nuveen is one of the world's leading investment managers with over 125 billion, that's B as in boy, in assets under management. So Carly, you bring to us similarly a breadth of experience and really, I think, overseeing a wide array, but particularly your focus, where we're at, where you've been this past year, and where you see things going would be great.
Sure. So thanks for the introduction. Thanks for having me. Excuse my voice. Last week was my first week traveling, back on the real estate circuit, actually going to see property and people outside of the state of North Carolina where I reside. And of course, step one foot into New York and I come back with a terrible cold. So I'm getting the tail end of that, but on the up and up. So thanks for having me again. Carly Tripp, I work for Nuveen Real Estate. We are owned by TIAA, for those of you who don't know us. A large manager, so we do a little bit of everything, but we're direct investors and mostly invest on behalf of third parties. Most of those third parties are pensioners, some individuals, but mostly pensioners representing teachers, doctors, healthcare workers, firemen, police, etc. So it's something that we take really, really seriously and take a lot of pride in. We invest across all sectors. We have 29 offices globally, so we also are global investors and about 600 employees across the globe. Most of our AUM is here in the US, but we do have significant AUM throughout Europe and Asia Pac as well. And, I don't know how much I can add in terms of market color that the other folks haven't added already. So I would just point, and draw to a couple of points that have already been made. Luis, I think, did a really good job of bringing up the individual sectors and the disparity of performance within those. And he mentioned alts. Alts is where we have a lot of conviction right now and a lot of growth prospects. So we mentioned single family rental, storage, life science, medical office, et cetera. We're really kind of thematic investors and how we focus our priorities going forward and our growth priorities. And so when we look to things like an aging population, we look at changing technologies, we look at growing cost of healthcare and the growing spend in healthcare, the alternative sector lines up really, really well with those. So that's a huge major focus. I'd point to, Martin's conversation on affordable housing. We're also large in affordable housing investors too. Have about 2 billion of affordable housing properties located in the US. And then Sasha, did a great job of kind of bringing up that population migration, something we've been very, very focused on going forward. So I think, more and more, we're going to see a decentralization in terms of the population and where people live and how people work and all of those fun things. And what technology has done is enabled us to really kind of live, work, and play from wherever we want. And so we've seen a ton of population migration, of course, outside of the coastal cities into the Sun Belt markets, and then, more recently over the last year into some of those vacation markets. Not sure if that'll stay or not. I too would love to work from the ski slopes or from Cabo, but I don't think they're gonna let me get away with that for too long. But we have been investing really, really heavily and overweighting our exposure within the Southeast over the last several years now. So that's been a big priority. And then, Andre, you mentioned PACE financing, something that we utilize, quite a bit on our end. I think it's a very advantageous and efficient way to invest in some of the transitional risks going forward, particularly within the office sector. And so actually Nuveen was the, first lender and originator to securitize a CPACE portfolio, and we just bought Greenworks, which Greenworks is the original PACE financier, so to speak. So I think that tells you that we dabble in a little bit of everything here at Nuveen, and I'm just really happy to be here alongside you all.
Great, thank you, Carly. Well, we have about 10 minutes left. So before that, what I want to do is just given our audience, this is hosted by the Hispanic Heritage Foundation. And I know I have a personal mission of just getting more Latinos in real estate, in commercial real estate, residential real estate. I don't care what it is, but any facet of real estate, definitely on the ownership side, that's one side of it. But what I want to have each of you kind of go around, given your experience. We have hundreds of years of experience really on this call today. And this particular group, the diversity of it, the focus of it, and just really want to each of you go around, and if you were giving advice to someone that wanted to get into this particular space, whether they were going to come in and work for a company or start investing somewhere, I guess, what would you tell yourself if you had an opportunity to get in? What would you tell that person out there, whether it's someone just getting in or maybe they have 10, 15 years of experience and they're looking to go to make that turning point? Let's start with you, Mina.
I actually thought you were going to ask, what advice would we give trustees like you on how do we make,
you can give me that too. Sure, that would be great. Yes. Actually, Mina, that's a good point, because I will say you can answer it one way or the other, because I will say that like I mentioned earlier, we're often focused when we're as the trustees on the private equity side, not always the real estate side. And there's so much opportunity there that I think goes unrecognized, unrealized. So yes, please focus on that as well.
Yeah. So, I think I'll start with that, because I think that is, as I think about allocators on the phone, and I see, you know, someone like Rodrigo or Stacy as well, right? Where from a CIO standpoint, or from a board, you know, another trustee board member. Look, I think that intentionality has to be there, because if there's no intentionality from, you know, from a top down, from a board or CIO to make allocations to firms that are women and diverse, or even asking the question of the, you know, of the mainstream firms, what is your demographics across your team? You know, who are your partners? Who are your mid-level? Who are your junior people? What does that look like? Does it reflect who we are as an institution? If you were a, you know, an LA Fire and Police or a CalPERS, I think that's absolutely critical and important. I will say, just kind of given post George Floyd, we're seeing so much activity, especially in the African American community as well, being highly intentional and unapologetic about it. And I frankly don't see that same energy on the Latino side. And I think it's just, you know, as I always tell my friends, you know, nos estamos quedando atrás, you know, because as a result of it. So I think being highly intentional, unapologetic about it is really critical. You could do it and ensure that you can institutionalize it from an investment policy standpoint as well. And, you know, and usually, I don't know, the Garcia rule or the Rooney rule, as kind of Gilbert always kind of has coined it. But it is critical, because if you don't put the pressure at the top, it will never filter down. So I can tell you a lot of like young people can get in and are right now having maybe more opportunities because people are filling those ranks at the lower level. So I think it's just about putting that pressure.
Excellent. Thank you, Mina. Let's go to Luis. What's your thoughts on this area? Oh, you're on mute, Luis.
Sorry about that. I was maybe from the perspective of someone who's young and maybe has an interest in getting involved, in whether it's in real estate or investing in general. I think, you know, especially here in the Bay Area, where it's been such a dynamic market for tech, you know, I think, you know, some of the more traditional sectors, you know, such as real estate, maybe gets lost a little bit sort of in the shuffle of the growth of technology. But I think there's a lot of opportunities for individuals that are, I think, interested in, and I think that one of the important things you need to have is just really curiosity and willingness to learn. And I think that's one of the, I know, foundations of us for investing is just always ask a lot of questions if you get involved in a business, and be curious. The other aspect, and almost even, you know, that things are continuing to evolve. I think technology has continued to emerge in almost all businesses across the, you know, even real estate. I think you see, you know, you talk about fintech, I think tech is also starting to emerge in a lot of different aspects of real estate. So I think there's unique opportunities for individuals who have an interest in maybe both to really kind of integrate those two, you know, areas to be able to grow and really provide value to companies and investment firms such as ourselves or others over time.
Excellent. Thank you, Luis. Marty, let's go to you, and kind of on the same, you know, I want you to mention what you want, but to Mina's point, I mean, you've worked with pension funds around the country for a long time and have that expertise. Where are we missing the mark? Where can we be better in this area? And any light you want to provide in general, I think we always look to you as a godfather of sorts in that way of knowing where to take us next.
No, thanks, Corinne. I think part of it is, to Mina's point, is really coming from the board level as well as kind of the staff to be involved, looking at those programs that are going to be inclusive and giving folks opportunity. And if they're given the opportunity, you know, they're either going to do well, and if they don't do well, you're going to terminate them. But I think that's where it has to start from the top. I think from the Latino side, there, you know, I guess there's lack of kind of, I guess, efforts to move the ball forward. But I think that's something that's desperately needed. It's happened in certain parts of the country, but that's the first part of it. And I think, you know, even going back to the point, where are some of the trustees missing out? I think it is some of those communities that have been underserved, but even in those Latino communities where there is robust buying power. We know those communities because we grew up in those communities, but we know that folks can be successful there and developing kind of projects here, whether it's affordable housing or commercial. And most of the real estate investors that pension funds are allocating to, they're going to fly right over these kind of neighborhoods and cities. They're going to kind of go and take the money from LA Fire and Police and Chicago Muni and New York City. But rarely are they going to invest in those communities because they don't know them. But you do have to look at some of the programs that can help fund some of those projects that are going to be successful. And to give you an example, Ross stores, which they're prominent in some of our Latino communities, but on average, they are 2 to 3 times higher in their gross sales, where average they might do about 7 million per year, but they're going to do a minimum of 14 million to 21 million in those Latino communities. And the highest kind of grossing kind of sales store for Nike is in South LA. So the buying power is there, the foot traffic is there. It's just getting the development dollars and the opportunities into some of those communities where they can kind of be maximized, and you'll probably see even better returns that you're seeing in the rest of your portfolio.
Excellent. Thank you, Marty. Carly, let me go back to you with 125 billion AUM and your expertise overall. It sounds like you're going back into real estate sites and around the country. If you're giving advice to a trustee or a pension fund, where are you directing folks on where to be right now?
Yeah, so sorry for interrupting you, Martin. Not only is my voice going, my hearing's going as well, because I swore you said Carly, and then I was like, Godfather. Nobody's ever called me the Godfather before. So anyway, where are we advising folks to go? I think a lot of the capital is going into housing, into logistics, and into alternatives, frankly, and into some of the growth markets. But I think at the end of the day, what we're advising is to be diversified, geographically be diversified across sectors, because, sectors individually and locations individually are all going to cycle in and out, be in favor at times and not be in favor during others. But I think, within housing, logistics, and alternatives, there's a lot of tailwinds and momentum supporting those right now. But that doesn't mean that you can't, make money if you're investing selectively, in office and retail either. So I think someone mentioned, e-commerce during the pandemic supporting industrial, and certainly it has, but the real winner during the pandemic was actually buy online and pick up in store, same day store pickup. So using something like Target as a bellwether, you look at their earnings, 95% of their sales are fulfilled from their stores, and they have, an omni-channel infrastructure that really, really works. So they're a retailer that you should point to, to look at trends. And, the buy online, pick up in store actually increased 300% during the pandemic compared to 40% for e-commerce. So in my mind, that's probably a more sticky format. And, it's something that's, I think, largely being ignored by institutional investors right now in terms of investing in retail. So I think if you're going to ignore the space, you're going to ignore a little bit of the return. But again, if you're going to go there, you have to be selective. And Corinne, I do want to kind of go back to your original question a little bit on what advice you would give to someone getting into the space. And there's one piece of advice that I've learned, and I'm going to tell my kids, and I wish somebody told it to me growing up, is focus on something and get really, 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 really good at that. And keep focusing on that. And it'll take years and years and years. But if you focus and you specialize and you become the absolute expert in that area, you're going to be really, really successful. And the most successful people in our industry that I've seen are the ones with the deepest expertise. So I'll pause there.
Awesome. Thank you, Carly. And we're going to check back in with you next year to see what you guys have all done too to increase diversity within your company and take us to the next level there, because you have the power to do that with so many investment professionals under you. So thank you for moving the mark there, and seeing a woman like you at the forefront is really exciting. So thank you. Sasha, Andre, we have literally about 30 seconds left. So I'm going to let you two wrap it up with some final words and take us into the end. Go ahead, Andre.
Sounds great. I would say, Carly, to your point, I think from a DE&I perspective, I saw the deal that you guys did with Antonio Marquez and Pan West. You guys acquired 600 apartments out of Atlanta. So I see you guys investing with diverse managers and actually following through. Women are running a lot of these very important groups. So we're seeing a lot of, diversity from that standpoint. So it's going to be really interesting to see how the industry continues to change. I guess the advice to trustees, it really comes down to what are the tools and programs that are in place to be able to attract that emerging manager talent, and also understand that there may or may not have aspects that need to be bridged. There will need to be some sort of like training and coaching. And we're starting to see firms like Blue Vista, for example, out of Chicago, that are doing manager of manager programs to really try to fill in that gap. And then to those that are coming into the industry, there's something for everyone. And that's what I love about the space. You could be an artist, and you can be an architect, you could be a very structured person and get into engineering or civil. You could be a finance person, you could be a developer, like, et cetera. And I think just getting access to different sorts of programming has been interesting. Shameless plug, through our nonprofit Real, we've been able to put 11 individuals through a certification program through the Urban Land Institute, ULI. And we're really exposing individuals to how the commercial real estate industry works from all the different food groups, from all the different aspects, and providing perspectives to those who are just stuck in a job.
Thank you, Andre. Appreciate it. Sasha, I'm going to give you about 30 seconds because I'm over, and all the other folks that are running this great event are reining me in. So I'll give you the last word. Oh, you're on mute, Sasha.
I guess advice is to really just bet on yourself. I had turned 40 last year, and I realized, I was like, wow, I'm making a billionaire more money, I'm becoming poorer. And what I decided when I thought about it, what I realized was you just have to bet on yourself. And what I mean by that is, start off, buy a house. If you have to get a bunch of friends, you pull a friends together, you buy a single family house, and then you go to a duplex and you build it up. And that's what a lot of people do. And I think when you do that, you show that you know what you're doing, number one, and then you build relationships. Keep in touch with people. Don't think short-term, think long-term. And those are the people that have backed you. Institutions can take a long time, but when you talk about family offices, high net worth individuals, once you have good camaraderie, those are the people that are really willing to back you and build you. Then you can build a track record to go into the bigger stage. That would be my advice.
Absolutely. I appreciate that, Sasha. That's what I tell. I spoke to some students at UCLA recently, and they said, how do I get into real estate? I said, you're going to rent anyway. Why don't the four of you go buy a single family property, and we'll figure out how to get you off title in about 5 years, but you'll have owned that property and got equity. So it's all about that. Thank you to the Hispanic Heritage Foundation. Thank you to all of my wonderful panelists that participated here today. I always say we could do a full day just on real estate and probably break this down even further. So if there's ever that opportunity, look forward to doing it, and we'll hopefully do this again next year. Thank you, everybody.